What is up, everybody? Welcome to the CRE News Hour, a weekly podcast where we come to you live at 3 p.m. Eastern Standard Time to discuss current events and everything commercial real estate. My name is Henry Eisenstein, and I'm here with my co-host, Rafael Collazo. How you doing, my friend?
Great, man. Can't complain. Had a closing today. Got a couple more closings coming up this week. So been a good week. I'm pretty excited. I'm actually here at a buddy of mine's office. He owns a construction company in Indiana, and we're going to have our monthly mastermind at 4 p.m. So thought I'd get to his office a little bit early and do this live.
Nice. Well, we all like closings, that's for sure.
Yeah.
Anything you'd like to share on the closings? Types of deals or whatever.
Investment. Both of these are investment properties. So one's a triple net investment property here locally. That's the one that closed today. Another one is actually going to be in Jackson, Ohio. It's a Pizza Hut triple net investment deal. And both
Nice.
Again, investment property, which over the last
what kind of cap rates?
They were actually pretty decent. 7.5, I think 7 to 7.5 is kind of what we've been getting. The one deal, actually both, the deal that's closing on Friday is all cash. And then the other deal that we had today was a heavy down payment. And this client of mine essentially just buys it and pays it off within a year or two. So this thing's going to be paid off pretty quick. And then we're going to hop on the boat again to try to find him some new stuff. But yeah, so that's
Nice.
kind of the deal we have working this week.
Sweet. Hey, congrats on that. That's awesome.
Yeah. So let's go ahead and kind of dive into the meat and potatoes to discuss a few new topics in commercial real estate. So one of the things I wanted to kind of share today was, I don't know if you saw this particular headline, but they are going to be revamping LIHTC, which is the low income housing tax credit. And this is something that really hasn't been modified significantly since its inception back in the 80s. And so it's kind of going to be interesting to see the effects of this. But essentially what they're trying to do is to boost the amount of credits that you can actually receive based on, it's kind of followed similarly to what was implemented in 2018, but it has expired in 2021. And also there's going to be a threshold limitation that is going to be dropped so that you can maximize the credits that you receive from LIHTC with less of a percentage of the housing stock that you deliver being, low income housing or having to qualify based on the average income for the area. So the hope is that by doing this, it's going to bring potentially up to 200,000 units online that, will help to try to address the affordable housing crisis. As you may be aware, I think there's 3 million unit shortfall of affordable housing in this country. And so any way that we can try to allow for more supply to come online, I think is beneficial. And so they obviously had talked about this particular legislation getting pretty much bipartisan support in Congress, and now it's on its way to the Senate, which, it may take a little bit of time to get through because they have some other legislation that's taking priority right now related to budget, and obviously their support of or lack thereof of things that are happening internationally, so foreign policy. So, but hopefully over the next, call it 6 to 12 months, we should have more clarity on whether or not this is going to go through. There's a lot of people who think it will, which again will bode well for people who want to do these types of affordable housing projects. So thought I'd just kind of get your take on it.
Yeah, I mean, I always think affordable housing has an interesting opportunity to it. I think that it really is a tax play, right? It's always been a tax play. I think it's never, like you're basically, the returns are heavily weighted more on the tax savings per se, right? Just because your income on these types of deals are pretty rough, right? It's not like you're not really getting into these things at, 8 caps or whatever, like you're not going to be getting heavy cash flow. But these are long-term heavy plays where, what I've seen in my area is that we look at affordable housing deals where we're buying it. There was I remember this a while ago. I was looking at it was like a 4-family house, which was at 50% of value or even less. It was like 50. It was like maybe 40 cents on the dollar of what it would traditionally sell for. But you had to deal with another, 18 years of affordable housing on it. right? And I thought it was interesting because it was like, you buy it at 40 cents on the dollar today, and in 20 years, it'll probably be worth, double market value today, right? So, you'd have what is that, an 8x, 6x or something like that on the income, on the deal. So very interesting way to look at it. And I think there's a lot of, I mean, look, this country needs affordable housing for sure, right? I definitely think that there's going to have to be something like this that gives enough benefit to the developers out there and the investors out there to even get involved in this scene. Or I really think we're going to struggle with housing for quite some time.
Yeah, and the interesting thing about LIHTC too, from my understanding, is that you can sell the credits. So that's what a lot of developers do. They'll deliver the product, and then they have this credit that's accumulated based on them delivering the product and following all the guidelines, and then they can, liquidize that credit that they have
Yeah, it
to
has
then.
like a value to it.
Absolutely. So, you could get in a situation where, granted, the affordable housing project may cost a bit more, but when you're able to monetize those credits, your equity position is much more strong. Thus, obviously makes it more attractive of an opportunity. And so, lowering the threshold, I think, will help because obviously that means more market rate apartments, which can drive cash flow. And yet you're still delivering a good amount of units because you can do more projects. And that's the hope that this particular legislation will bring. So hopefully we can see more and more become available so that we can try to continue to address the crisis, because it is a crisis. I mean, there's no question that without more inventory coming online, it's only going to become more expensive in this country to rent. So
100%. I agree. And actually I brought up a couple articles in regards to, the world of renting, or at least one article here about that later on today, which we'll talk about.
yeah,
But this next article is going to be quite interesting. I thought this next article here is about the world of flexible office space. I think there's a massive opportunity, which I think is interesting, right? Like, so IWG here, right? They run the world's largest flexible office space investment company. They just posted their highest revenue in the last 35 years. This is the Regus and Spaces of the world, right? This is by square footage, is mass, a lot bigger, substantially bigger than and locations wise bigger than WeWork. And I think that it's kind of fascinating how this company in 2023 had their biggest revenue year in history. After what the craziness of the office markets being adjusted, right? So I actually thought this incredibly surprising. I would have never imagined seeing that they were actually hitting numbers like this. So I actually, kudos to them. It's actually quite interesting how they were able to pull this off. I guess, whether it's part of the fact that they're more international, and maybe international basis have way more people coming to the office more than they have people in the US. Maybe it's a piece of their ability to structure better leases. Maybe it's a piece of it that, maybe they got better locations. I'm not sure. I mean, it's honestly quite fascinating how they were able to do that. Curious to get your thoughts.
yeah. I mean, look at this. Gross profit increased by 41%. It looks like
Insanity.
and the margins up from 15.9% in 2022 to 20% in 2023. That's nuts, man. Could you imagine that type of performance in a company? I mean, that's what shareholders dream of. So that's
Huge.
amazing. But yeah, I'd say you're right. I mean, I think, partly, businesses desire to have more flexibility in their leasehold interest, right? Being able to not have to sign up for a 5-year lease for an office space, and maybe having more flexibility while paying a little bit more is something that a lot of people are interested in. And then also the fact that WeWork has been going through some turmoil as well. So their biggest competition has been crippled or affected greatly. So, I mean, it's kind of a perfect storm in a positive way for this company, I'd imagine. And, as a result, they're having very profitable years. And I don't see this.
It's just wild.
Yeah.
Wild.
And it's great. I mean, back in 2020, which, I think in hindsight, I'm glad it didn't work out, but I had tried to undertake a small co-working space development. I was going to buy this building and then redevelop it into like a co-working space. and do essentially the same thing that this particular company was doing. And obviously it didn't work out because the banks wouldn't touch co-working with a 10-foot pole. But, there was a demand. Obviously, you've seen this kind of uptick in co-working because of the fact that people are kind of hesitant about signing up for these long-term leases on office. So, you know,
Yeah.
2020 hindsight, I guess, but I don't know. Thought it'd be interesting to share.
Yeah, I just think it's so interesting that like one company could be doing so well and then WeWork is just getting absolutely decimated. But I do believe that they probably over-indexed in some really tough markets. Like they over-indexed in Miami, they over-indexed in Manhattan, they over-indexed in a lot of these areas where they're paying huge prices for leases, and they're probably their lease agreements probably because I don't know if you noticed, but they're also suing now SoftBank. Like all the leasees, the
Oh yeah.
landlords are now they're suing SoftBank for their money that they're owed. So it's just
Yeah.
interesting how
Well, it makes sense. I mean,
there.
they're the only ones who have any assets, so it would make sense. You go after the parent company to try to
Exactly
recoup to get your money. So yeah, that's going to be an interesting story. I'm sure we'll talk about some more articles in the future about how that transpires because that whole tale is yet to be decided. So, but next up is labor insurance costs rising, but U.S. hotels continue comeback. So, again, this kind of a recurring type of trend that we've highlighted in previous articles. As we're well aware, labor costs have gone up significantly, and insurance costs not only in multifamily, but also in hotels has gone up. As you can imagine, because of where they're located in the country, there's been a lot of damage done to a lot of buildings in general, not just multifamily. And so you're seeing kind of a uniform increase in insurance pricing across different property types. But again, U.S. Occupancy for hotels have been very strong, as you can kind of see here. 2022 was actually a really strong year for hotels, and 2023 beat out 2022 based on occupancy. They also highlight here that RevPAR, which I think is revenue per available room, also increased. That's a metric that a lot of hotels kind of follow along with. So again, it's just kind of highlighting some of the trends. So it talks about insurance expenses have gone up by 19.5% through Q3. So again, kind of in line in lockstep with what you're seeing in the multifamily space. But there's still a strong optimism in hotels going forward. The existing stock of hotel inventory is still suppressed. I think they talk about a little bit higher up here that the development of new rooms has been kind of suppressed over the last year or so. It looks here at the end of 2023, 152,000 hotel rooms were under construction nationwide, a drop of almost 5% from a year earlier. So you have you still have an existing supply, but occupancy rates have been increasing. The supply that's coming online is lower than what has historically been delivered. So you're probably still going to see a high occupancy rate going forward. And, revenue for each room is still going to remain pretty strong. At least that's what projected. That's what projected for the next year or so. So
I feel
again,
like the hotel industry as a whole has just been doing fantastic recently. They came back with a vengeance after 2020. I think that numbers in every aspect are up across the board. I think it's a fantastic asset class. I mean, this is not surprising, but what is surprising, I mean, none of it. I mean, the pieces of the expenses going up is also not surprising, right? Like we've been talking about how the insurance costs in a bunch of key markets are going up like crazy on the in the apartment markets or the apartment asset class. It's not surprising that we're going to see the same across the board here. So, I mean, this is the piece that no one likes to pay attention to, which is that even if you get a great deal, insurance costs are crazy. Labor costs when you're, now when you have a, really successful hotel, you're going to have a lot of staff. You're going to have to pay them well. You're going to, in order to keep them, you're going to have to give them benefits. You're going to have to make sure that they're, you're adequately, you're staffed and, it can be an incredibly expensive business to operate. So just something to keep in mind that yes, hotels can be a fantastic option, but you really need to pay attention to the fact. I mean, think about it. Your insurance cost goes up 20%. Your labor cost goes up, 5, 10, 20%. I mean, all of a sudden your profit margin's gone.
Yeah, 100%. Yeah. And you're running an operating business with a hotel. It's not just a real estate play. So you really have to understand the industry and make sure that you're able to deliver the experience that your clients are seeking. Now, I'm interested to see now with, obviously Airbnbs have been affected nationally. There's a lot of new legislation that's coming down that is going to be restricting certain properties from actually operating as Airbnbs and VRBOs. So with shrinking inventory in that space, what's going to happen in the hotel space? I'd imagine it's probably going to increase demand for those products. And to be honest with you, like the only way nowadays when I go to Airbnbs, like it's only typically for like bigger groups. But if I'm going to go for a business trip or a conference, oftentimes I'd prefer to just be conveniently located at a hotel that's close to the
Sure.
conference center or whatever. And so, it's kind of
Yeah.
a shift in demand.
I think Airbnbs, like, especially in areas like Miami and stuff like that, like there's so many. There are
Mhm.
so many Airbnbs here in Miami. I think it's one of the most oversaturated things ever. That I've never experienced anything like that with oversaturation. There's just so many different options. So it's like almost like, you look at it in some extent, it's like, what are really the benefits? It's like you're paying the same thing. Like this cost is almost identical. In some instances, it might be cheaper to get hotels or vice versa. But it's like, why, hotels where I can go down, I can get room service 24, all this type of stuff that's super easy. I don't know. It's just like,
Yeah, and
it's
then
interesting how
like
that dynamic
yeah,
changed.
with Airbnbs, I'm sure you stayed in places where it's like, "Oh, we want you to clean this and do everything else," and it's like, "Okay, like I could rather stay at a hotel and, obviously I'm
Exactly.
there for a short period of time. I don't want to have to worry about all the different, nuances of keeping this place like you
100%.
would want it to be kept, right?" So it's just,
Yeah.
a little bit of that. So, all right,
Yeah.
so
So
next up. Go ahead.
yeah, next article here. Macy's closings could raise risk for billions of dollars in CBS mall debt. This is obviously to be in tandem with the fact of, look, Macy's is closing 150 locations. This was noticed, right? The bidding war for Macy's coming as the retailer plans to close 150 locations or 150 stores has implications for shopping mall owners nationwide as billions of dollars of loans that finance these centers. Because what happens is that the income, obviously, from Macy's locations, um, if they end up leaving, right? If let's just say they're paying 200, 100,000 a month, 200,000 a month, and the margin on the loan, right, is 100,000, 150, 200,000, and all of a sudden they leave and that loss of income is there, you're going to trigger, an event with the loan. So very, very interesting, actually, being a mall owner and realizing it, like, when you own shopping malls and you have to have your hand, you have to be very close to the pulse of what's going on with so many of these different companies, around the world, right? Like what
Mhm.
companies are doing well, what companies are not doing well. What is your roster look like of all the people, your tenancy look like, and who's getting affected by what. And this could actually be very, very interesting, especially with those malls where like Macy's was their big anchor. And then all of a sudden Macy's leaves, where Macy's could possibly be 70% of the mall's income, depending on the occupancy of the rest of the building. So it's just a very interesting thing. Actually, if you scroll up a little bit, you see actually that Macy's, they're actually bidding on the company right now.
Oh,
I
further
think there
up.
was
Yeah, I was up here,
yeah,
right?
out there. Yeah, there's a business that's trying to buy them. There's actually another article. I didn't actually bring it up here, but Macy's is reviewing a second all cash buyout proposal from two investment firms delivered on Sunday, valued at $6.6 billion, which actually sounds like could be an interesting opportunity here. The company has yet to make public the list of 150 stores they plan to close over the next 2 years. So this will be very interesting once they really disclose what those locations are. But it's like, again, like, look, I'm buying a 17,500 square foot retail center. When you have certain tenancies, you're going to want to look at how those tenants are doing, right? Like, especially if you have Class A tenants, like you have, anything that might be on the, S&P 500 or the Fortune 5,000, whatever it is, or these types of lists of, you want to be paying attention to these types of businesses. How well are they doing? Both private and public companies. You can try to look into those details because, listen, the retail world is interesting. It's very, very, the detail of which, getting to know how your tenants are doing can all be found online. Unlike, obviously, apartments where like you're kind of hoping, you do your due diligence, you make sure they're not criminal and they got decent credit and they have decent income. This is like where, all of a sudden you could lose especially if you have multiple malls and multiple locations with Macy's, it could be very interesting.
Yeah, absolutely. And obviously you talk about the debt on some of these malls. A lot of these loans have provisions within them that allow you to meet certain debt requirements, and there may be provisions on certain tenants, like if this tenant goes dark for whatever reason, that could potentially trigger the bank to have to reevaluate your loan. So it's definitely concerning for a lot of these landlords. And also, obviously I do a lot in the tenant space, and I've worked a lot in the retail space. And I know that oftentimes when I negotiate on behalf of some of my tenants, I'll try to incorporate like a go dark provision, meaning that, if one of the major anchor tenants goes dark, then the tenant that has the right to either get their rent reduced significantly. So there would be a percentage, they'd pay like a minimum rent based on that tenant going dark. And if after a year that space remains dark, or 2 years or whatever that number is, then we could choose to terminate the lease agreement and relocate to another location. And that's not necessarily, I mean, obviously a lot of larger landlords will try to push back on that provision, but I've gotten it through a couple times. And so, imagine you have a center that's anchored by a Macy's that has 15 to 20 other tenants on site. And for whatever reason, 5 to 10 of those tenants have those provisions in there. It could be really crippling to your center if, they decide to exercise those. So,
Yeah.
there's a very nuanced type of look at some of these.
No, I mean,
Yeah,
look, this is like the beginning of a domino, right? Like, the
yeah,
beginning of the domino's fallen. So, very, very interesting to see what happens here.
yeah, absolutely. And they were just showcasing some of those spaces there. It's kind of interesting.
Yeah, and they have multi-100,000 square feet locations in some instances, which could be, the entirety of a center.
Oh, absolutely. Yeah. No,
Think about,
oh,
I mean, think about
100%.
the 1031 guys. I mean, like I joke about this all the time. It's like, imagine being a 1031 guy and you 1031 and spend 20, 30, 40, 50, whatever $1 million to buy a Macy's that has a 10 or 15-year lease. You buy it at a 7 cap, you pay, crazy high price per square foot. And then they go, then all of a sudden your tenant leaves, right? It's like, all of a sudden now you overpaid on this huge property that needs a ton of work. It's like, what are you going to do at that point?
Yeah. Or the people who always look at it and they see a deal and they're like, oh, it's a 9 cap. For example, you buy a tenant's center with a Macy's in it, it's like a 9 cap, and you're like, oh yeah, that's like an attractive deal. But the reason it's priced at a 9 cap, or maybe is because there's a high risk of a tenant vacating. So, again, just because you're getting it at a quote unquote good price, it may or may not be a good price if that big tenant leaves. So you got to have those downside case risks or analysis when you're making those decisions. Otherwise, you may find yourself in a up
Quite a
shit creek
predicament.
without a paddle, as they say.
Yeah, absolutely.
Yeah.
What's
All
next
right.
article
So
here?
next up is senior housing's net absorption hits 5-quarter high. So they talked here in the last 3 months of 2023, more than 11,000 senior housing units were absorbed, net a 5-quarter high. So they talk about how an average absorption for this product has been roughly 8,500 units per quarter. It is driven to a nationwide occupancy of roughly 84.3%. So it looks like there were just 110 basis points shy of the pre-pandemic baseline. So, they kind of talk a little bit about how the inventory is, again, we're having issues with delivering inventory because construction costs are elevated, labor costs have been increased. And so we're not able to keep up with the demand for this type of senior housing. And Marcus and Milchap kind of described that there's going to be more capital that comes into this space, and particularly on existing facilities. So if you own existing senior housing developments, you're likely going to see a increased demand for that product because of the fact that, being able to deliver a new facility can be so cost prohibitive, especially in this environment. So
Yeah, what's
talk a little
interesting
bit about
is
some
no, I
trends.
mean, look, senior housing. I mean, like, look, with especially with the baby boomers. I mean, like, they're talking about like what is it? I mean, it's the largest demographic of the United States, right? Like, is the baby boomer population, and slowly moving towards the ages of retirement, going towards this type of thing. It's like, I mean, like, look, this is a massive opportunity for a lot of people to get involved, right? I mean, it's a super ever growing situation for the next 30 years, right? Like, there's just that demographic is going to be a massive opportunity in the senior housing market. Trying to target, for development is going to be incredibly important. Trying to target certain situations where you can, get into a situation where you can get into a senior housing deal. I mean, it's going to be a huge opportunity to make some money. So I'm a big fan of senior housing. Haven't done any senior housing deals as an investor yet. Definitely looking to do that, when the opportunity arises. So love this
Yeah,
type of article.
absolutely. And obviously, you always talk about targeting areas of, certain property types and kind of going after it again, and really focusing on property types that are attractive in the current environment. Because what may not be, we know right now that senior housing is going to be on fire going forward, and obviously there's demographic trends to support that. So if you're deciding to contact or cold call people on a particular property type, you could do a lot worse than contacting these facilities to try to see what their interest level is. So
Yeah, I agree 100%. I mean, look, this is also, these are the types of articles that always go make you my brain turn, that go like, hey, like, it's not just about some of these industry or these asset classes that are hypothetically doing fairly well. It's like, guys, like, pay attention to where the money's going, right?
mhm.
It's like, if you see this type of opportunity, prospect for it, right? If you have a buyer who's avidly looking for senior housing, prospect for it. Like, there's a lot of money in every asset class. You just got to be prospecting for it. So, anyways, this goes back. We were just talking about the rental market, when you're talking about the affordable housing. These types of developments are very, very interesting, which is the build to rent communities that are being created, which are actually, like, in the right circumstances, putting some pressure on apartment housing, because, it's like, if the rents are within reason, percentage differences from an apartment building to a house, it's like, why on planet Earth would anybody ever choose to live in apartments, right? Like, especially, if they're, if everything's about the same rent wise. So very interesting here, the build to rent communities. If you scroll down just a little bit, it shows here that scroll down just a little bit if you can.
Yeah, I'm going to right now.
Yep.
Sorry, I was just it was slow to get to. Yep, there it is.
Oh, good. So yeah, so here you go. Driving much of that growth has been players such as Blackstone, whose namesake real estate investment trust started in 2024 with a deal to purchase Tricon Residential, a Canadian developer with 38,000 built-to-rent houses in the United States for $3.5 billion. Which is, I mean, if you guys think about it, which is absolutely insane to think about. Okay, if you run the numbers here, $3.5 billion. Okay, let's do this math. I'm gonna do this on my calculator real quick. 3.5 billion divided by 38,000 units. That means they're buying an average of nine. I can't even do this, without the camera. I don't know. 92,000 a unit. They stole. They stole these freaking houses. I mean, that's amazing. A great acquisition on Blackstone's part. $1 billion spent. I mean, like, this is just, it's a smart move. I mean, like, guys, like 92,000 unit. I guarantee you the average rent of those types of units had to be more than $900 a month in rent. So they bought a fantastic opportunity there. Great deal for Blackstone, as always. But this is just a huge opportunity, right? Like, you can dive into a few of these pieces here, but I think this is really, really smart, in the certain parts of the country.
Yeah, no. So interestingly enough, so our office does a ton of land, and so we deal a lot with different types of developers, not only locally but really nationally. And one of my colleagues in the office was representing a build to rent developer from Chicago, and they were looking in the Louisville metro market in particular, in a subsect of the market called Jeffersontown, which is kind of a mid to upper income area of the city. And so they were looking at some parcels of land that you know that could have been a very good use as far as a build to rent community is concerned. And typically, when you look at the hierarchy of what people can pay for land, especially in the residential space, you've got like the home builders, like the Pulte's and some of these other large big box developers that usually pay the least per acre because they have to be able to get the margins that they need to. Build to rent developers are kind of middle grade, and that they definitely pay a good amount more than the Pulte's of the world, because they're able to hold the property for a long period of time, and the economics tend to work out better. Obviously, apartment developers can pay the most because they get much more density per acre. But the problem is multifamily development projects tend to be a little bit less attractive in certain areas. And so getting it past the municipal hurdles can be kind of hard. And so oftentimes, like, when you're educating owners about the fact, like, hey, yeah, this multifamily developer maybe offer you, let's call it $1 million more for the 50 acres or 30 acres that you own, but we can actually get the deal done because we're going to be able to deliver something that the municipality actually wants, versus a multifamily developer who says they're going to bring 500 units to an area. And there's plenty of NIMBYism out there, like not in my backyard, that don't want to have those types of developments come into play. So it's kind of like a balancing act where you have to kind of sit there and try to educate people about whether or not why this would be a bit more beneficial to go with this offer than it would be to go with something that has a very low probability of getting done. So, anyways,
Yeah.
that's kind of my
So
two cents on build
no,
to
I
rent.
agree. I mean, like, look, but like, for those people who are out in Texas, you guys can obviously reach out the firm here, Legacy MCS, which is a third
Mhm.
generation multifamily contractor in Austin, Texas, which has obviously been focused on doing a lot of this. But you obviously see here, if you leave it right where it is here, it's a build to rent. It's still scroll up again. Sorry.
I'll go. Wait, further up?
The build, yeah, further up, right above the picture. Where it says like here, build to rent is still a small portion of the U.S. single family housing. It's only one. You keep passing it. Scroll down.
I keep passing it. I'm sorry. Here, better.
Keep going.
Keep going.
A little bit. Last paragraph there at the bottom. The build to rent still. You keep passing it. Right above the picture. Right above the picture.
Right of the picture. Oh, okay. Right here.
Right above the picture. There you go.
It's delayed. Go ahead.
It's all good. So it's like the build to rent is still a small portion of the U.S. single family housing, accounting for just 1.7% of the 340,000 rental units, according to obviously CBRE. What's interesting here is that like I obviously just think there's a lot more of this to grow. I mean, like it's literally 1.7% of the entire market. I think that we're obviously going to start seeing a major uptick in this over the period of time. I mean, National Rental Home Council data said that the build to rent completions have ballooned 270% since 2019. In 2023, nearly 25,000 build-to-rent homes were completed, a 62% increase over 2022. So I just think this is going to become a bigger and bigger opportunity for people to get involved into. And obviously, this is pretty unique to the markets, the submarkets in which it is actually profitable to do this. Like in New Jersey, it would be really hard to make this profitable, to be honest with you. Unless you're in communities where you can try to make the dollars and cents work, but anyways, I think this is going to be a really huge opportunity for people in where there's a lot of land, right? Like, the Carolinas, Texas, Kentucky, Florida, the Sun Belt states. I think this is going to be a huge opportunity for things to be a little bit different instead of trying to do a lot of apartment housing. I think that, going the build to rent model might be ideal.
Yeah. Yeah. And obviously we talk about mortgage space, like building relationships with these build to rent developers, because again, you can deliver from an acquisition standpoint, you may be able to pay more than the Pulte's and some of these other large or big box developers for like residential communities. And you're competing with apartment developers, but again, it's not as attractive as something like this, that essentially the density is not as significant. So again, just something to consider long term.
100%.
All right, we'll get up to the last article. And this one's been in the news for a while, so I know that we'll have, I'm sure, a good discussion on it.
I'm ready. Let's do it.
All right. All right. Next up, and kind of our last article, is NYCB. So New York Community Bank stock tumbles to lowest level since 1996. All right. So what we but essentially what's been happening is the New York Community Bank. Oh man, my computer's acting up. So the New York Community Bank has been affected greatly by what's been happening. Essentially, they
Your connection's kind of messing up. Are we losing? We're losing him. We need to resuscitate Raphael. Can you hear us? So I'll kind of dive into this. Yeah, New York Community Bank is obviously, this has been in the news recently in regards to the tumble that they took. If you can see the screen where I see it here, is that the shares of New York Community Bank have fallen 23%, hitting their lowest levels since 1996. People. So this is, obviously this is quite the interesting phenomena. That has affected the world here financially. So, let me try just going to read this here. The stock. Oh, it's just me. Hey, everybody. Yeah. So real quick, while I actually have your attention, because he actually just, stole the news article right off of me. So what I'd like to do is that if you guys are tuning in, I'd love for, because what we're going to actually try to do moving forward is that we're going to bring on a few guests. We're actually going to start having more guests on the live streams here with all the news articles. So we're going to be bringing on investors, commercial lenders, attorneys, you name it, big time players in different markets all around the country. So if you have anybody that you recommend that you would love to have us on the have us invite them on the show here, please drop it in the comments on any of these videos. Tag us here. We appreciate you guys obviously tuning in. It means a lot. But again, we're going to start having a lot more of these new people coming in as guests, similar to the Patrick, the PBD podcast. I've been following Patrick for quite some time. I absolutely love him to death. So we're going to have Patrick's kind of model on here, which is we're going to start having guests on here quite frequently. So for those of you who are looking, maybe know of anybody who might want to come on the podcast, make sure you tag them here or send a direct message to Raphael or myself when possible. We'd love to try to have on some amazing guests. So if you guys know of anybody you'd like to have on here, we'd love to try to interview them. That would be awesome. So got your internet figured out. Let's have you jump back into the article.
Yeah, sorry, man. I don't know what happened. It just, and I was in mid sentence, and I guess it went off.
All good.
But I will dive right back in.
Everyone just likes staring at my beautiful face. It's all good.
Yeah. I mean, it's better that way anyways, right? So, all right. So really what I was kind of highlighting, and I'm sure we've talked about this briefly, but the New York Community Bank stock price dropped to its lowest level since 1996. If you guys have been following along with this, essentially what's been happening is that they reported unexpected losses based on essentially bad debt that they've issued over a period of time. And that's manifesting relatively recently. I think their chief risk officer resigned relatively recently within the last couple months. And then they issued a statement saying that everything was fine. And now it looks like they're looking to potentially get more of a capital infusion to kind of backstop some of the losses. And so obviously that's led to a lot of people concerned about what's going to be happening going forward. And the New York Community Bank is not a small bank. I mean, this is a very meaningfully large bank, kind of the ilk of Silicon Valley Bank. And so,
look
people
it up
are watching this very closely to see what happens over the next several months and weeks to make sure that they're able to modify. And obviously, this is going to be meaningful from a governmental standpoint to make sure that this doesn't cause like a contagion where more banks default, and kind of what they were worried about with Silicon Valley Bank. And most likely what will end up happening if they're not able to resolve their liquidity issues is some big bank's going to come in and probably buy them up, kind of like what they did with First Republic and Silicon Valley Bank.
Apparently, I'm just looking this up right now. Apparently, New York Community Bank is the 29th largest bank in the United States.
Yeah. And so what was Silicon? Do you know what Silicon was? It was probably even higher than that. It could have been.
No, it was substantially higher. I think it was way larger. Silicon,
like top 10, maybe top 20. I don't know. It was definitely a large bank. I mean, that was
16. It was the 16th largest bank, and it was the second largest bank in the United States history ever to fail since 2020.
And was Bear Stearns considered a bank? I guess they were probably the largest, but
I'm not sure. I doubt it. Yeah. I don't think so. Maybe.
You don't think so? Hey, we're learning here. We're all learning here. But
that's right.
But again, it just kind of goes to show that, there's material weakness in some banks that are pretty large, and that could potentially cause an issue of a more grand scale if, one fails and then another one starts to fail. It's kind of what happened in the Great Depression. You started seeing run on banks, and all these banks started to fail, and the government obviously didn't step in quick enough, and that caused a significant financial crisis. So I think what they're trying to do.
This is also goes to show, as a fan of Chase, I'm a huge fan of banking with Chase. You have to be careful with where you keep your money, guys. Like this, as stupid as that sounds, and I'm BSing with the Chase thing. Like I am a Chase Bank guy, but like it is important to pay attention to where your money is, because if you're banking right now with the New York Community Bank, I would feel very worried. I would be very worried. I'm not going to lie to you, right? Because a bank that's not paying attention to their financial circumstances is going to have troubles eventually, right? And think about it. They're lending out all of their deposit money, right? So if you have hundreds of thousands or millions of dollars in their banks, they're lending out your money. I mean, that's how they make money, right? So it's like if they're coming into issues, and you have several $1 million with this bank, and there's only a $250,000 FDIC insurance, you might have some issues here, right? So especially this is what happened with Silicon Valley Bank, right? Like they were starting to have some issues just like this. People freaked the heck out as they started pulling their money.
Mm-hmm.
And once everyone started pulling their money, all of a sudden now it created this major issue, this tightness around how much money they could actually be lending out. And they ended up getting into, major issues where they ended up having to be bought out by, I think Chase actually bought them.
Yeah, I think they either bought First Republic or Silicon Valley. I know the government had to step in because I'm sure they didn't, because Chase is probably the most well-capitalized bank in the world. And so they probably could have bought up both. And maybe they did. I don't know. They bought one of them. I think either Republic.
Let me see. I think maybe you're right. I think it was maybe.
I think they bought First Republic, but I don't know who absorbed Silicon Valley.
Bought Silicon Valley Bank. Silicon Valley Bank was acquired by First Citizens Bank.
Okay.
Which is wild to think about.
And that could be a shell bank for Chase. Who the heck knows?
Citizen Bank size rankings. Let's see what this one is. Silicon. Let's see. First Citizens Bank size rankings. First Citizens Bank is 13th.
Yeah,
which is wild.
So yeah, I mean it's nuts. I mean, and that's why, like you said, being able to bank with a bank like a Chase, who is literally, you don't have to worry about them. We're obviously big fans of Jamie Dimon and the things that he's been able to do with the bank. So I agree with you on that front, especially if you're an entrepreneur, because you're right. FDIC insurance only goes up to, like you said, was it 250,000 or 300? I can't remember. 250 grand. So if you have more than that in your business account, which hopefully at some point you do, if you guys are listening to this, I'd hope you have much more than that at some point. You got to make sure that the bank's stable, because if they're not, then you run the risk of losing out. So anyways,
this is why a lot of people try to leave all their excess cash. They leave it in the money markets or whatever, because the banks don't have number one, they don't earn much money on your money. I mean, up until recently, where now it's like 5% or whatever, but or treasuries, it's why these people just leave all their money out of it. But yeah, super wild. But anyways, great articles today. Any other, I was mentioning before, while there was a little technical difficulties, that if they have anybody who they would like to have us on as guests on the show, that they should definitely make sure they drop it in the chat box down below, in the comment section. We'll make sure we try to have them on, because we're going to start trying to do guests hopefully in the next few episodes. So make sure you guys stay tuned for that. Anything else, my friend, before we rock and roll?
No, that's it, man. It's always good seeing you as always. And like you said, I think it'd be great to have other minds come in. And again, we just want to become the watering hole for all commercial real estate news, dialogue, and discussion. So anyone that you if you guys are watching this, if you think that there's anyone in particular that you guys follow that, you think would add good commentary to what we're trying to do, obviously would love to have them on the show. And really, again, we want to become kind of that news show that everyone tunes in every week and kind of, follows along with. So,
100%.
Yeah.
Well, we appreciate you guys tuning in. Thank you guys so much. And we'll see you guys next week, 3 p.m. Eastern Standard Time. So take care, everybody.
See you guys.